In this week's video, we will cover an investment scenario that may be playing out now, or it may play out sometime down the road. But when it does, stocks could drop at an unprecedented rate. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Early in the news cycle on Friday, January 29th, two headlines appeared that dovetail nicely with this week's topic. First, Bank of Japan stuns markets with surprise move to negative interest rates. You may not have heard of negative interest rates because it's a very unconventional policy, and it's a policy that you consider implementing after conventional policies have failed. And then a little bit later on Friday morning, it was announced that U.S. GDP came in below expectations. Economic growth in the United States came in well below a 1% figure. That would be tepid growth. The stock market cheered it as bad news is good news. What do we mean by bad news is good news? Well, in the market's mind's eye, markets rise as weak U.S. GDP dents prospects of Fed rate hikes. Typically, when the economy is weak, the Fed stimulates, and as you will see in this video, at some point in the not-too-distant future, it is very possible that bad news will be bad news. Before we shift gears into the three legs of the stool story, let's just look at a few charts relative to Friday, January 29th. The market model helps us with volatility to respect and volatility to ignore. This is during the big rally on Friday. It's roughly 2 o'clock on Friday, January 29th. You can see we still have the bearish moving average crossover with about 2 hours of trading left in the trading month. Lower high relative to this high. Blue is below red. The slopes of both are down. And if I put price on this chart, price is below. This is the big rally on Friday. Stocks here during the day are up 34 points. It should also be noted that it was the end of the month, and earlier in the day, TLT, or long-term treasuries, were outperforming the S&P 500 by over 11% for the month. At the end of the month, if you're running a balanced fund, meaning a mutual fund that owns stocks and bonds, many of them, by mandate, are required to stay in balance at the end of the month. If you're going to rebalance that type of portfolio today, you would be selling bonds and buying stocks. So there was one additional driver on Friday. Is that the only reason why stocks went up on Friday? No, it's not the only reason, but it is a significant reason when big moves and big pools of money are being reshuffled in balanced funds. 2 weeks ago in the video, we used the example with the common 50-day and 200-day, and we can see, especially if we remove the noisy and volatile price from the equation, it's the exact same chart with the S&P 500 up 34 points almost on Friday at roughly 2 p.m. Slope of the 50-day is down. Price is below both moving averages. Blue is below red, and the slopes of both here are down. And on the other side of the three legs of the stool story, we'll show numerous charts that paint a similar picture, that right now, this type of rally, even if it carries on for multiple days or maybe even multiple weeks, given what we know today, the trend is clearly down on this time frame. The trend is clearly down on the monthly time frame. It's the model's way of telling us right now, given what we know today, this is volatility to ignore. If it morphs into something else, by rule, we will be forced to shift our allocations. In this week's video, we're going to cover the three legs of the stool story. If you've heard the story before in one of our videos, bear with us. We're going to tie it into 2016, and we're also going to talk about what we would look for to negate the story from having an impact on 2016 and 2017. The first leg of the stool involves stocks. Kathy and I both started with a major Wall Street firm back in 1994, and anyone that's been involved with the markets since that time is familiar with this expression. You can't lose money in technology stocks. We all heard that countless times, right, wrong, or indifferent, between 1997 and the year 2000 when the NASDAQ was soaring. Unfortunately, once investors started to lose faith in the myth, the NASDAQ dropped from 5132 in the year 2000 all the way down to 1112. That represents a peak to trough loss of roughly 78%. Now we'll move to the second leg of the three-legged stool. And between the year 2002 and 2006, when home prices were rising, we were all familiar with the expression, you can't lose money in real estate. We're also all familiar with the expression, if it sounds too good to be true, then it's probably too good to be true. The second myth and the second leg of the stool was sawed off by the markets when housing prices peaked in 2006 and then dropped over 32%. And now our story brings us back to the present day. This article, posted on Fortune.com on August 24th of 2015, sums up myth number 3. The Fed can always bail out the financial markets. A logical question is, if myth 3, or the third leg of the stool, is still intact, what could bring the myth to an end? It all comes down to perception. If the markets begin to believe that the Fed has lost control, the third leg of the stool will begin to crack, and eventually it too will break. How could that happen? Over the past few years, the Fed has used every tool in their toolkit, including printing money hand over fist with QE, and the markets are beginning to realize and question and doubt, after all of this, has it really led to a strong economy and lasting growth? In the next few slides, we'll talk about the next bullet point, which is the weak economy scenario with no bullets left in the Fed's chamber. It's very important to note that myth number 3 is still in place for the most part, and we do not know when the third leg of the stool will crack and give way. It may be happening now, it may happen in 3 months, it may happen in 3 years, it may happen in 30 years, but eventually myth number 3 will be relevant. This bullet point does not appear to be imminent, but if we can avoid a crack in the stool in 2016, it's possible later on down the road that it's inflation that forces interest rates higher, and then the Fed starts to lose control of rates, and the economy starts to turn down, and the market starts to turn down as well. The only way that you can combat rising inflation, for the most part, is to raise interest rates. That's very, very difficult to do if you have somewhat of a stagflation situation with rising inflation and a relatively weak economy. Given what we know today in late January of 2016, it's much more likely that this bullet point here would be more relevant in the current calendar year than this bullet point here. Therefore, let's take a closer look at the weak economy and no bullets left scenario. Regular viewers and clients know that we're not big fans of forecasting and predictions, and it should be noted that everything we're talking about here will have zero impact on what we do. The model and the facts and the rules will govern all of our movements. And if this scenario comes into play, the data will not miss it. We do not need to anticipate it. Hypothetically, how could the financial markets in 2016 or 2017 or 18 or 2030 begin to believe that the Fed is losing control? If you've been close to the markets, you're very, very familiar with the game plan for the Fed. This is interest rates here, the effective federal funds rate. Let's just call it interest rates for conversation's sake. This is the year 2000 here. You can see before the dot-com bubble burst, interest rates were above 6%. And therefore, when the economy went into a recession, the recession is shown here in the shaded area, the Fed had bullets in its chamber and it fired them by lowering interest rates in an attempt to stimulate the economy and the financial markets. Eventually, lowering rates did help because we know the stock market and economy did start to turn in late 2002 and early 2003, and a new bull market started in equities. Going back in history here also allows us to show what a normal economic cycle looks like. Typically, when the economy starts to improve, earnings are strong enough, employment growth is strong enough, confidence is strong enough, enabling the Fed to raise rates several times as they did between 2004 and 2006. The normal script is the economy and earnings are growing at a rate where the stock market and economy can handle the higher rates, and then eventually, after monetary conditions have become tighter over a period of time, the economy once again rolls into a recession. Here is the shaded area. When we go into a recession, the Fed goes to its basic recession playbook and starts to fire some bullets in the chamber by lowering interest rates. And in this second anecdotal case from history, when the Fed lowered rates in an attempt to stimulate growth in the financial markets, the shaded area ends here, telling us that the recession is over. And if you know your market history, you know that the stock market bottomed on March 9th of 2009 and entered a new bull market. They lowered rates. A new bull market started in late 2002. They lowered rates to stimulate during the recession, and a new bull market started. Maybe sometime in the future, this example will be used in economics books to explain the law of diminishing returns. It appears as if the Fed may have taken this about as far as it can go, and that's strictly a hypothesis at this point. The market will be the one to make that decision going forward. Typically, what happens, as we just described, after you lower rates and leave a recession, the economy becomes strong enough, enabling rates to rise again. In this case, it didn't happen. This is a very, very, very unusual period here. The stock market has gone up because the Fed has basically kept interest rates at artificial levels for a long, an abnormally long period of time, but they have never felt that the economy was strong enough to enable them to do what they wanted to do. They wanted to raise interest rates. Why? Because they need to put some bullets back in the chamber in the event that another shaded area appears over here in 2016 or 2017. And this is where the credibility problem is starting to creep in, and the markets are starting to notice that the Fed could become very, very vulnerable here if that shaded area does indeed appear. Notice when the recession starts here, as the dot-com bubble is bursting, interest rates are above 6.5%. When the housing bubble starts to finally deflate, interest rates are above 5%. Hypothetically, if earnings go into a recession and global growth slips into a recession or even starts to move in the wrong direction, the Fed really doesn't have any bullets in the chamber. You can argue that they can always implement QE4, and hypothetically that's true. However, there is risk there. It's possible that QE4 could impress the markets. It's also quite possible it could have the exact opposite effect by spooking the markets as they begin to realize it's possible that the third leg of the stool is not only cracking, but it is breaking. If we look at this chart in the context of the rally on Friday, January 29th, after the weak GDP figures, it should be noted that Fed stimulation during bear markets and weak economic periods does not necessarily stem declines right away. How do we know that? Well, you can see here interest rates are dropping, and they drop for quite some time. The stock market is falling significantly in this area, and the stock market doesn't bottom until late 2002 and really doesn't find a bottom until March of 2003. Therefore, rate cuts did not necessarily stem the market decline. Same thing occurred here. The Fed starts to cut rates, and rates start to fall before January 1st of 2008. And as we all know from market history, the stock market plunged into March 9th of 2009. Let's shift gears now into some 2016 hypotheticals. The market will decide what happens going forward. This is one possible explanation and one possible scenario of many. If you understand monetary policy, and if you're a central banker, this is a scary looking chart. If one of these gray bars starts to appear, we really do not have an easy way to combat it. It is possible that this scary looking chart led to this scary looking headline that appeared on MarketWatch earlier in January of 2016. It's also possible that this scary looking headline is also reflected in this scary looking weekly chart of the NYSE Composite Stock Index as of the close on Wednesday, January 27th. This is a possible topping formation, a left shoulder ahead, a right shoulder, and we are flirting with the neckline. We have not clearly broken the neckline, and as long as price can stay above this blue line, from a probability perspective, there is hope for a bullish move in this direction. However, if we break and stay below the neckline, the probabilistic and hypothetical target would take the market down to this level here. Now we can start to gain a little additional insight into what may be bouncing around the heads of money managers and investors. Fool me once, shame on me. Fool me twice, shame on you. Now, keeping in mind that the third leg of the stool is still intact. However, given these two stool breaks are fresh in many market participants' minds, it is possible we are very, very close to the stage where people are saying, stop me if you've heard this one before. And as a result, given that we also have a similar and scary probabilistic setup that may be forming in the month of January 2016, it's not a stretch to imagine that if the third leg of the stool is giving away, or when it gives away in the future, that investors might run for the exits at a much much faster rate the next time. Will the next time turn out to be calendar year 2016? Nobody knows the answer to that question because charts cannot predict the future. As we covered in last week's video, charts can assist with probabilities. So as of the date of this recording, what we know is we have unfavorable setups. We also know that ugly looking charts and markets that have ugly or unfavorable risk-reward profiles can begin to see improvement at any time. Therefore, how does all of this help us? Under our system, the three legs of the stool story won't change anything that we do. However, it can help us from a psychological perspective to understand if a plunge starts to take place that seems to be a little bit abnormal. Whether or not that happens remains to be seen. And as always, we'll head into next week with a flexible, unbiased, and open mind, understanding that the hard data, the charts, the risk-on, risk-off ratios, the market model, and the rules will guide us if we're willing to listen. What could take the three legs of the stool story off the table for 2016? The answer is easy. A strong economy and favorable earnings puts us more into the traditional mode of the economy is strong enough to handle Fed rate hikes, allowing them to put the bullets back in the chamber so when a recession comes on the other side, they can lower interest rates. What happened on Friday, January 29th has nothing to do with a strong economy. If anything, it aligns with the three legs of the stool story that says it's possible the economy is rolling over here and the Fed has no bullets left in their chamber. Again, that can be negated if the economic data improves. There are countless things from a fundamental perspective that could cause the next recession or bear market. This is one possible candidate. This is the title from Bloomberg. Unprecedented 29 trillion corporate bond binge that has left many companies more indebted than ever. And you'll notice here in the graph, we hit a high point during a bear market in 2003, and then we fall. We hit a high point during a bear market in 2009, and then we fall. We are at a high point potentially again here. The graph shows companies' debt to earnings ratios is currently at a 12-year high. In fairness to the Fed here, the Fed is not supposed to be responsible for all of the heavy lifting. The economy is supposed to have the free market involved, monetary policy, which is what the Fed does. And there's also supposed to be fiscal policy. You can write a letter and contact your local congressman because for the most part, fiscal policy has been absent and Congress has decided to put the weight of the world on the Fed. It's something that may be in the process of backfiring now, or it could backfire sometime in the future. For clients that follow along on Twitter, you may have gotten the impression that we were not overly concerned about the big rally on Friday, January 29th. When you see these charts, you'll understand right now, given what we know today, it's volatility to ignore. How do we know that? We'll go through this once and then we'll cover it on numerous charts at a high rate of speed. They all paint the same picture. If we can understand what extreme bearish conditions look like and what extreme bullish conditions look like, it helps us understand everything that falls in between, including the present day. So weekly chart, this is a full bore bearish look with price below both moving averages, blue below red, and the slopes of both are down. Notice how this looks quite a bit different than full bore bullish. Price is above both moving averages, blue is above red, and the slopes of both are up. How does the exact same weekly chart look during the trading session and big rally on Friday, January 29th? This chart is at roughly 1 o'clock on Friday, January 29th. This is a weekly chart, so this is the weekly tally here. Right now, this looks like a counter trend rally and volatility to ignore. This doesn't look that much different than this, or this. or this, or this. Now let's move to the longer duration time frame. We're using the exact same concepts here. Blue is the fastest weekly moving average here. This is what a risk-off situation looks like in 2007. This is what risk-on looks like. If we're bullish on this time frame, we prefer to see price above all of the moving averages. In blue, the fastest moving average on top, and the slopes of all of them are up. Even at 1 p.m. during the big rally on January 29th, we still have a full bore bearish look with price below all the moving averages. The fastest moving average blue is on the bottom, and the slopes are all down. This period here looks more like this period here or here than this period here from a probability perspective. Is it possible that this chart here morphs into something like this? Absolutely, positively, yes, but we need to see a lot more than what we've seen thus far. Counter trend rallies are not unusual. In fact, they are common during a bearish trend. They are also common during a bullish trend. We've been involved within studying the financial markets as professionals for over 20 years, and thus the market model has an incredibly deep bench, much deeper than what we show in these weekly videos. The model follows the NASDAQ weekly as well. This is your full bore bearish look during the 2001-2000 period, the dot-com bust. This is the bullish turn that takes place. This is observable evidence that takes place. I can see this before good things happen. This speaks to probabilities. This speaks to probabilities. If we're bullish, we want it to look more like this than this here. Even in the context of the big rally on Friday, January 29th at 12:38 p.m., the NASDAQ was still negative for the week. Right now, this looks like a full bore bearish look. It looks like this. It really doesn't look anything like this. We're always open to improvement, but we need to see it, and we don't have it on this chart yet. The market model also uses numerous risk-on, risk-off ratios. This is one example. This is the S&P 500 stocks relative to defensive treasuries. This is what a full-bore risk-off looks like when the market is nervous, telling us that stocks are underperforming defensive bonds, or TLT, in the ETF world. When the market turns in March of 2009, the ratio doesn't miss it. We can see this. This tells us that the probability of good things happening is much better here than it was here. And in this case, good things did indeed happen. Since there's no perfect indicator moving average or risk-on, risk-off ratio, the market model looks at the weight of the evidence, and you can see the weight of the evidence here also aligns with volatility to ignore at this point. Roughly 11:53 a.m. on Friday, January 29th, the S&P 500 was still underperforming defensive treasuries by over 1% for the week. In the ETF world, when fixed income investors are confident about future economic outcomes and they believe there's a low probability of default, they'll chase yield, and therefore they will invest in higher yielding junk bonds. They'd rather chase yield if there's not going to be a default. If we feel the economy is starting to turn, we'd prefer to take a lower yield and get something that has a higher degree of safety of principal, or we feel more confident about getting our principal back. This is what fear looks like in early 2008. Here, the reason why we're using this mutual fund is JNK was not around in trading at this point. We could plug JNK and TLT into these charts and get something very, very similar today. This is what improving confidence looks like about future economic outcomes in early 2009. Junk bonds start to outperform because people believe that default rates are going to fall and they'd prefer to get the higher yield. The same chart in 2016 still has a risk-off or full-bore bearish look. As noted on Twitter, it's very, very easy to understand that counter trend rallies are a normal part of downtrends. It's much, much more difficult from an emotional perspective to understand that counter trend rallies would be part of any downtrend in the present day as well. You can see you get massive counter trend moves within the context of a bear market, telling us that green days and even big green days and big rallies are not unusual during any downtrend. The previous chart showed the dot-com bust bear market. Same principles apply to the financial crisis bear market. There are massive counter-trend rallies and numerous green days, even convincing-looking green days, that take place within the context of any downtrend. The main purpose of the three legs of the stool story presented in this video is to help us understand future possibilities. If a large drop and fast drop in the equity markets seems unreasonable, it may be helpful to know that the Fed has even considered a scenario where the stock market falls 51% in a 12-month period. This quote here, if you want to pause your video player, comes from the Financial Times, and it talks about the Fed's stress tests that include the stock market tumbling 51% in a year. The two videos that might be helpful from a contingency planning perspective are the ones with the titles Bear Market Risks Increasing at Rapid Rate and Monthly Stock Signals Similar to 2001 and 2008. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.